Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around Australia on the Community Radio Network. I'm really pleased to welcome to the microphone this week, for the very first time, George Haramis, who is the CEO of moneyGPS. Welcome to the show, George.
Thank you, Ray. It's a pleasure to be here.
Wonderful. Look, it's really a pleasure to have you on the show. This is one of my favorite things that I love talking about. I'm an ex-tech head. I used to be in the software industry for many, many years before I cross-trained into finance. I think the tech industry looked at me and said, "You're too old." I rejected that, but there we go. I'm in finance these days. But I love fintech. I think it's the way forward. But there are some nuances out there. And George, I think it's really good that you've come on the show. We'll talk about some of those nuances during the show. But before we get into that, maybe if you can explain to the listeners and viewers a little bit about who you are and a bit about your background.
Will do. Thanks, Ray. Look, just in terms of my background, I've been in the financial services industry now for 36 years. Most of that time I've spent running large advice practices and organizations for the institutions, financial institutions, and for the banks, running one of the bank's private wealth teams, but also been involved with a couple of privately owned organizations, the first of which was a company that set up Asgard, which is Australia's first master trust. That was quite some time ago. So really my experience is in engaging with advisors, managing financial advice businesses, building those businesses, turning them around. And about 13 years ago, I got the itch and left the corporate scene and started my own business, a small boutique AFSL, an advice business, which was an interesting experience.
For our sins, when we start our own business,
that's
then
right.
They say, yes, be your own boss. It's like,
then everything that I told advisors sort of came back to haunt me in terms of what I should and shouldn't be doing in my own business. So if any advisors are listening out there and they're thinking, George told me to do that, but that wasn't quite the thing I really needed to do. My apologies. It's a little bit different when you're running your own practice. You take out the rubbish. You're the PA, the EA, and everything else, as you'd be familiar with. But
absolutely certain of that.
Yeah. What it taught me was all about small business and the sacrifices that small business goes through. But I gained a lot of experience in dealing firsthand with accounting practices, other advisors, and really setting up a value proposition for the end user, the client. So love that. Sold that business, and then after a couple of years, started moneyGPS with my co-founder, director Drew Fenton. And now we've been going it was 5 years this May. So thank you very much. We've survived during a very, very interesting period in financial services sector, particularly with initiatives like the Quality of Advice Review being undertaken during that period. So it's been a very interesting journey in building a financial technology company and digital advice products, but also in navigating the review of the advice area through Quality of Advice Review and the government's view of that, but also the government's view of digital advice, which is what we do.
And I guess from that perspective, George, we have Peter Johnson, who's the Executive Director of the AIOFP, the Association of Independent Financial Professionals, come on the show quite regularly and talk about QAR, CSLR, and a whole range of different government policy matters. And from that perspective, the dearth of financial planners that's occurred over the last 5 to 10 years really has had a substantial impact. And Fintech is a much used acronym. So Fintech's, I guess, from my perspective, was always going to be an important part. But why is it increasingly important now in your mind, George?
Good question, Ray. Look, 5 years ago when we started moneyGPS, we saw the gap in terms of the number of people who could afford the cost of traditional advice, comprehensive advice.
Yep.
And and sort of in rough numbers, I think a single advice plan, one topic that a financial planner would produce is somewhere around $2,000 or $2,200, based on advisor ratings research that I can remember. And
right.
the median cost of a financial plan, a comprehensive plan, multi-topic, is around that $4,500 median price. So 80 to 90% of the population cannot afford those fees, cannot afford the cost of traditional advice, let alone the ongoing advice that you'll need to make sure that you're on track and your investments are doing okay, and to cater for varying, changes in circumstances. So we realized that the only way that you could engage people cost effectively and for them to have access to personal advice is through digital means. So we started moneyGPS with the objective of designing digital product or digital advice documents, SOAs, statements of advice,
Yep.
that where a client could take a fully client-led journey, self-led, and at the end of that, they would be provided with an appropriate SOA that's in their best interest to use and implement the advice without the need of a financial planner. Now, we've achieved that. We've created a number of products in investment, superannuation, now pre and post retirement, and soon to be insurance, statements of advice, sub $200 in price per topic.
That's very, very price competitive then. Yes.
It's exceptionally competitive. The key thing that we've learned during this process is that whilst the technology is really important to allow people to engage and to receive personal advice, you still need that human element in the process. So we have, as part of our sort of value proposition, that yes, you can take a number of digital journeys. We have a digital fact finder, which produces quite a comprehensive analysis of someone's financial position. We draw a line in the sand. If you complete it today, Ray, I'd ask you to complete it, but we don't take high net worth and sophisticated investors. So you'd be triaged back to an advisor. You're probably earning too much money, got too many assets, but so you'd be qualified out. But once you complete the fact find and you are issued with what we call a money checkup for under 45s trying to get their lives in order, financial lives, or our retirement checkup for pre-retirees, it will then, the algorithm and the calculation engine will then identify which advice topics are in the best interest for you to access. And it will actually close the door on advice topics that are not in your best interest to access, as well as, yeah, sorry.
So you've highlighted some really interesting points then, because one of my questions that I was going to fire at you was around artificial intelligence. And given the hullabaloo that's been around the markets in general since the announcements last year in early 23, there's so much discussion around AI. I've seen it now for about 3 or 4 years. And much has been talked about robo-advice. And before we got on the show, you and I were talking about this, that there is a very distinct difference, though, isn't there, between robo-advice and the kind of what you're doing that has a bit more of a human touch?
Very, very big difference. Just to clarify for everybody listening, moneyGPS has its own AFSL. It's an unrestricted AFSL. We issue our advice documents under our AFSL. So that includes strategy as well as product recommendations.
Okay.
But in what we do, we try and mirror what the financial advisor does in their process. The only difference here is that we issue single topic advice, so one topic at a time, and using digital means. Now, it's personal advice, hence the reason we issue it under our AFSL. We take on the risk. The difference with artificial intelligence and robo is this. Let me just first start with robo. Robo was a sort of buzzword back a few years when you could complete a risk profile, and the technology would analyze that risk profile and say, Ray, hey, you've completed the risk profile. It looks like you're a conservative investor or a growth investor, and they would issue a statement of advice purely on investment only options. So you'd invest $5,000 or 10,000 through, or maybe 20,000 into a model portfolio which would mirror your risk profile, and that's it. That's all it does, right?
And in fairness, that's a fairly simplistic view, and you're right. But that's been quite popular, and we've talked about these, and we normally don't use a lot of product names, but I guess from that perspective, the StockSpot, Chris Bricky type of offerings out there. There are a number of them around now, and they serve a good purpose. They do the basics, and it gives people a good entree. But I guess what we're talking about now is a fintech that you're looking to push out in the market that does a bit more because there is that human touch.
Well, correct. The robo-advice service serves a purpose from an investment point of view. We've broadened out our suite of products and services to look at delivering, to actually provide personal advice topics that cover superannuation, investment, pre-retirement planning, and then retirement planning, and soon to be insurance services. So you could access a range of advice topics that deliver personal advice under our license, as opposed to a confined suite of products in that robo advice area. So we're more aligned to what an advisor does, but in a digital sense, than a straight robo advice operator, which is very focused in what it delivers to people, because there's a need. They're more proactive. They're into sort of buying stocks or ETFs and things like that.
Sure.
Ours is more for the 80 or 90% of the population who know they need advice, can't afford traditional advice, and really this is the only affordable or effective way they'll be able to engage personal advice with a human touch. But it is delivered under our AFSL.
Right.
So we have to adhere with all the regulations and the requirements that any AFSL would in delivering digital advice.
And ladies and gents, that also includes membership of AFCA, the Financial Complaints Authority. It also includes making sure they're insured so that if anything goes wrong, and this is again, we were talking off air, ladies and gents, that there are a lot of people out there sprouting on TikTok and saying stuff that, in the normal light of day, George and I would get into an awful lot of trouble for doing so on this show or anywhere else. Sorry, George.
No, you go. Sorry, I interrupted.
And so from that perspective, we are always very, very careful about what we say and how we say it, because we are liable for everything we say and do, and as we should be, because we are charged with the responsibility. I guess, George, your own license, I don't give personal advice. My license doesn't cover me for that, but I give general advice only. But your license is quite specific because you actually do personal advice.
Yeah, we deliver personal advice just like a financial planner would. The only difference is that we deliver it and create it digitally. We have to meet the same regulatory and legislative requirements that any AFSL would. Hence the reason why I'm the responsible manager. We're about to appoint a second responsible manager, and we deliver all the advice on behalf of the clients or accounting firms that use us, or advisors that use us, or employers that use us. That's what we do. The artificial intelligence issue is an interesting one. Everything we do in this business is rules-based. There's legislation and regulatory requirements that we follow. The way we deliver advice is on a rules-based approach. Therefore, that's why we don't use artificial intelligence, because it learns. And the point of that is we've already learned, we know what the rules are, and we deliver advice and analyze the client situation based on those rules, not about, well, let's see what we can do here with the client based upon trying to learn. So we don't use artificial intelligence, and that's the reason why. Rules-based systems using algorithms based on an AFSL requirements is secure enough, and we have our documents reviewed by lawyers and compliance people on a regular basis. I can confirm that by showing you the bills that I get from the lawyers and compliance people. They are very, very good advisors to us, but I can confirm that's what happens on a regular basis. Yeah.
Cool. Well, okay. Look, George, we're just about half time right now here on Dollars and Making Sense, a weekly show about finance, money, and investing. I'm here at the microphone with George Haramis from moneyGPS. We're going to take a short break and be back with you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm really pleased to have at the microphone this week George Haramis from moneyGPS. He's the CEO and co-founder. George, you and I have been talking a lot about fintech and not AI, surprising to our listeners and viewers, because AI, I have some idea that I like what AI can potentially deliver, but I'm still, I guess, because I am a technologist at heart, dubious, because it still needs that human touch. And when we're talking about personal finance and the fact that you were saying before we went to the break, yours is a technology and platform that actually still delivers personal advice with a human touch. And so what I want to move into now is how the landscape is changing. I recently had on the show Andrew Inwood, who is the CEO of Core Data. Great guy, just stats coming out of his head. I love sort of rubbing his shoulders because I get brain cells falling off him onto me. He's so smart. Now, he's talking about a potential $5 trillion of wealth transfer in the next 5 to 7 years. And so from that perspective, how do you see fintech really starting to take a role in this wealth transfer activity?
That's a really good question, Ray. If you think about the transfer of wealth or intergenerational wealth transfer and the $5 trillion, they're big numbers, but intergenerational wealth transfer has always been happening. By the very
of course
fact that the people pass away, assets are being transferred to their children and loved ones and so on. This is the biggest transfer of wealth ever because of the baby boomers, the biggest ever. It's really important, I think, that people understand that there are avenues to engage advisors and technology companies like moneyGPS to get some assistance in establishing appropriate plans for their children, for their families, and so on. It's also important that they understand that their financial advisors can help themselves and their children in dealing with this intergenerational wealth transfer, because the kids need to be educated. And the kids need also some support to help them set up appropriate plans. There are avenues for accountants and accountants in particular who take up technology platforms like moneyGPS. There's more than moneyGPS in the marketplace, but accountants are often viewed as the number one trusted advisor. And by that very position, engaging an appropriate technology provider that can deliver affordable advice for people that might have simple needs, simple situations that don't need the more complex, costly financial plans, where the advisors are really putting their skills to the fore and developing those plans for people that actually need it at that level. So technology has allowed the population of those that that can't afford traditional advice to at least benefit from the solutions that the tech can deliver in delivering some form of advice to help them and their families. And I think technology has to have a place here, because there simply aren't enough advisors in this country to cater for everybody that needs advice. There's only 15,300, 400 now, dropped from a high of 26,000. So tech is very important to facilitate advice that deals with the intergenerational wealth transfer at an appropriate level that people can afford.
And I think that's the key element. And this also draws upon some of the topics that I was discussing with Natasha Panagis, who's the superannuation expert at IFPA. Now, Natasha and I were recently chatting on Dollars and Making Sense about what's value for money. And so when people are looking at shelling out, $3,000, $4,000, $5,000 for a financial planner. And hey, I was talking to a client that was looking at investing in us the other day, and they're telling me they spend 15 grand a year.
Wow.
For their financial planner, and that's their business. But the thing is, if they perceive and see that they're getting value, then it's appropriate that they spend that money. And particularly when, in a Sydney or a Melbourne marketplace, and even in Brisbane and other locales now, when this intergenerational transfer involves a piece of real estate that is now worth $2, $3, $4 million, $5,000, guys, seriously, ladies and gentlemen, it's not a huge amount of money to have an expert then advising. But that's not what we're talking about today. We're talking about, and I had this down as a question, when we're talking about single topic, now single topic can be a really interesting thing, because when we're talking super never ends up being single topic, does it? And so how do you try and keep people on a single topic? Because if you're talking super, you're going to end up talking about TPD, you're going to end up talking about life insurance, and estate, and how do we move stuff in and out of estates, and binding notices and the like. So how do we do this in a simple form?
So very good question. I mentioned earlier that our process is that everybody completes a digital fact find, and the algorithm, based on the information put into the fact find, creates a report. For under 45s, it's called the money checkup. It's a factual report. For the over 45s, sort of under 60, it's the retirement checkup. What the algorithm does, it analyzes the client situation and determines the most appropriate advice topics that will help the client achieve their objectives, one advice topic at a time. It also determines the other financial services that the client should utilize or access to help them achieve those goals, or those in financial objectives. Hey Ray, you should review your mortgage because you could do better. You don't have a will. You need to review your life cover, your TPD, trauma, and so on. So when the report is completed and issued to the client, it will show the client the advice topics that they can access, one topic at a time. It doesn't mean that we only give them one topic. It means that we offer them one topic at a time to complete based upon the circumstances. In theory, they could complete 3 topics in a day, but it's one topic at a time based upon our analysis and the way we deliver advice. And if they need to speak to someone about those topics to help them to the next step, it's our in-house people, our GPS coaches, ex-financial advisors, that deliver general advice to the client, Ray, answer any questions, validate responses, but also, very importantly, if they find that the circumstances are more complex than what's been input, they triage the client to their financial advisor.
And so I guess when I think about a journey, because to me, financial advice and financial growth and wealth transfers, etc., it's no different to a journey of, you're born, you live, and then you shuttle off the mortal coil. But I guess it sounds like there's a path. And again, I was talking to Tasha recently. My adult children are at the beginning of their financial journey, and so it's primarily around super. But one can imagine by the time they reach their 40s and 50s that they are looking at single topic. But then as they get closer to retirement, they may be looking at a more holistic type of service that they would then do that financial planning. So you can see sort of a pathway, can't you?
Yeah, look, you can. And the beauty of something like a money checkup is that, particularly for the under 45s or whoever it's suited to, provides that pathway, provides the detail they need to actually get their financial lives in order, cement their position, and then start to grow their wealth. As they become older, earn more money, and so on, if their circumstances are more complex, at least they've got the basics right, and they can move to a financial planner if it's warranted. If they continue along the digital path, digital is such that these days we can deliver pre-retirement planning with multiple retirement income statements of advice, as well as other advice topics that the digital providers can create at that retirement end of the spectrum. And that's because we've been around for 5 years, others have been around for just as long, and we've become very good at building product and using the technology to cater for the accumulators, the wealth builders, and now the pre and post retirees. That's the beauty of the tech at an affordable price, right? Whether it's moneyGPS or other digital providers.
And I think that's the real key, ladies and gents, is I think finding what suits you at a price point that I think makes sense no matter where you are in your journey. Now, one of the things we are on about here at Dollars and Making Sense is takeaways. I like giving listeners some key takeaways. And so I guess, George, if you were to plant 1 or 2 seeds with people that are listening or watching this broadcast, what would be that message that you would want them to take away?
I think the first message is that if you ever thought you couldn't afford financial advice, the takeaway is you can. You can afford advice because it's sub 200. In fact, it could be sub 100 for some topics that people can afford. The bulk of the population can afford this. So that's the number one takeaway. The second takeaway is, no matter what age you are, whether it's if you're working, you're 19, 20, 21, it's never too early to start planning.
Oh,
And
I couldn't agree more on that one.
Kids these days are very, very good at tech. They like doing their homework online before they meet with anybody. I know my family, my kids do it. So I would encourage them to look at the tech, look at the multiple providers, and just get going as a starting point. And if mum and dad, if you're young enough and mum and dad have got a good accountant, use the accountant. But by all means, in a general sense, find a good accountant as a starting point. If you don't have a planner and you've got at that complex age, then, or complex stage rather, I'm sure your accountant can help. And number 4 is, look up moneyGPS, I guess, and have a look at us if it's of interest.
Well, we also direct people to moneysmart.gov.au all the time,
Okay.
because it's a government website. And again, they talk a lot about fintech, and it's the kind of message that we're continually trying to get out to people. If you haven't started, start. Today's always a great day to start. So George Haramis, CEO of moneyGPS, it's been a real pleasure to have you on Dollars and Making Sense. Thanks for joining us.
Thanks very much, Ray. It's been a real pleasure from my point of view as well. Thank you.